And he took me under his wing and taught me how to trade. Now, remember, this was back when the tape was a physical piece of paper that you had to hold in your hand and read. And how come did my screen just disappear? It disappeared on my monitor. Okay, it seems to come and go. So he taught me how to trade by physically looking at the tape. And so many of the things that he taught me way back in the 70s are included in the accumulator algorithms that we use today. So what we do is a lot different from everybody else. So I'm going to put up this screen here so that people can see this. So we have two basic pieces of software, and they're designed to work together. The delineator is our trend model, and it is this program right here. And it's a derivation of the McClellan oscillator, but we use it quite a bit differently than they use it. And this program tells us which direction to seek trade setups. Now, what we do that is so different from everybody else is we're not really trying to predict the market. Some of our trades are, but the bulk of our trades are not designed to predict the market. They're designed to predict what direction we're going to be seeking setups, and whether we're going to be seeking long setups or short setups. And that is the bit here where it says the delineator tells us when and in what direction to trade. We have these two very basic, simple rules. Rule number one is price follows the slope of the delineator. And number two is we trade when cycle momentum is high and avoid when low. Now, none of our software is based on price. So when I say cycle momentum, I don't mean how much price has moved up. Cycle momentum is a function of the change in signal weight, which is market breadth, measured by the delineator. And the relationship of cycle momentum and signal weight and when and in which direction we are going to trade is something that I can tell you in 2 sentences. Now, I don't have the charts up. I've got the this little thing up. The charts are in back. So we can predict every day what tomorrow is going to be like, whether we're going to be seeking long setups or whether we're going to be seeking short setups. So we don't predict the market. We predict which direction we will seek setups. And all of these are based on trading intraday ranges. I have found over 10 years of teaching people how to use the software, and I've exposed well over 1,000 people to it over 10 years. We trade intraday ranges, and once you learn how to use the software to trade the short-term ranges, then you can know how to trade the longer-term ranges, because as all of you know, swing trades are much more difficult to trade and expose you to more risk than do intraday range trades that have very specific targets and a very specific means of achieving those. So for swing trading, the delineator tells us in advance the direction, the magnitude, and the duration of each cycle, and we know that in advance. And over the course of a couple of weeks in our trading schools, we teach people how to determine these. Direction is always very easy, but the magnitude and the duration is a little more involved, and it takes time to see it. The accumulators are used to support the trades from the primary delineator and identify ranges. So that is our basic thing. And we've got whoops, let me do something here. Hold on. So here's all of our software, and the delineator is this program right here. And these little windows these have our trades posted in them. But what we're really interested in on the delineator are the levels that are defined by the chevrons. So this is a down chevron, this is a double down chevron. Single chevrons are not as strong as double chevrons. And we use these for identifying our levels. And if you're a range trader, levels are everything. And so we, for example, this morning, we knew at the close on Friday that there was only negative cycle momentum available for today, and that we would be seeking short setups, not long setups, short setups. Now, that doesn't mean that we were predicting that the market was going to fall. We were predicting that we were going to be seeking short setups, because cycle momentum is what gives us the amount of time that we can sit in a trade and hold through a counter trend price move. The market price always resolves in the direction of the slope, the direction the slope is moving, which is this line right here. Actually, it's the change in X over the change in Y. So it's really the difference from this point to this point and this point to this point. But that's expressed in this graph here. And when cycle momentum is very high, and this morning it was over minus 100, it was minus 115 at one point, we know that unless signal weight is extremely strongly positive, that any rise in price was not going to sustain and gave us opportunities to build short setups. Now, the one thing that our software does that nobody else's software does that I've seen, and how we teach our people, is everybody knows you're supposed to buy low and sell high. But all of your price following tools and things get you to do the exact opposite. They get you to buy the highs and sell the lows. And so the process of getting people to sell highs and buy lows is what our cycle momentum disciplines allow us to do. And the trade that we made this morning, so let's bring in our accumulator here. So the accumulator is a tape reader, and it now tracks 9,000 stocks in real time, and you can bring them up at any time on 3 different time frames. So if I wanted to switch this SPY over to the 15-minute time frame, all I got to do is push that button, and that will go back to 1 minute. So what the accumulator does is a variety of different things on the tape. And again, if anybody has any questions, go ahead and pop them in. I'm watching the chat room there. So there are multiple different types of accumulators, and each accumulator measures something different. We start with the market pressure accumulator, which is a measure of demand. I take as a given that supply is constant and that it's demand that changes. So what the accumulator does, what the market pressure accumulator does, is measure that demand. And if we come over here and we look at this program right here, let me move this out of the way. Well, I'll just go ahead and leave it there. So many people think they can read the tape manually with their eyeballs. Well, they'd have to have a fly's eye and a photographic memory to be able to do that. Here, this little box right here is measuring simply looking at trade rates on SPY. So starting at the open, which was 3 hours and 44 minutes ago, we've had a total of 93,772 trades. We've had 4.8 million quote changes, okay? 4.8 million quote changes, and the BBO, the National Best Bidder Offers, changed by over 1 million times. Now, there's just no way in you can see those. And if we look at our burst monitor, let me find that. Here's the last trade in SPY, okay, at 110.14. There were 24 trades, but 1,197 quote changes. Now, that's 1,000 quote changes in a single second. There's just no way, I can guarantee you, if you looked at your Thinkorswim trading platform or TradeStation or any of these others, there is absolutely no way that you will see 1,100 quote changes over that second. They just simply can't provide that level of resolution on those tapes. There's too many people on them. So you're seeing a fraction of what's there. plus the fact that 99% of all quotes, and a quote is an order, are already expired by the time you see them. So there's absolutely no information that you can glean manually from looking at the tape. And if you think you're seeing something, you're deluding yourself. And if you're making money, then you're very lucky, and I would go with that. So what the market pressure does here is show us that from the open, and if we draw a horizontal line, which is the open, we do not do these kinds of lines. You'll never see a diagonal line on one of my charts. We just don't do that. So we can see that starting at 9:50 in the morning, demand started increasing, and it increased up to about 10:15, and it flattened out, and then it started rising again at 10:40, and it flattened out here again at 11:02. As price was moving up into this high, it flattened out, and then it never went above that level. Even though price went higher, demand was lower at this second high. And that's how you read that. The market pressure, not all accumulators are predictive of future price direction. They are all 100% accurate in what they measure. But not all accumulators are predictive on all symbols, because all symbols trade uniquely. I'm sure you've seen that SPY trades differently than QQQ, and that trades differently than Tesla, for example. So the more you trade an individual stock, the more you understand how it behaves. So that's the market pressure accumulator. The liquidity accumulator looks for a specific kind of transaction. And we look at the full feed, and this one is quite predictive in direction, future price direction, and we use it for all of our setups on SPY. So we can see here, looking at the full feed accumulator, that it's basically flat. It's up a little bit flat on the day, but you can see if we drew a straight line from the opening level, and remember, we're looking at the graph of the accumulator, not the graph of price. These are two independent graphs on the same plot. So whether an accumulator is above, below, on top of, crossing through price, it doesn't matter. These are two. I could change the positioning of the accumulators by changing the number of bars that we're looking at. And you can see, oh, it's down below price here. These are, again, scaled so that the highest high and the lowest low are shown across the scale of the graph. So let's go back here to 250. Let's go to 300. Here we go. So we can see the beginning of the day. So we can see what happened during that time frame. We set up, we looked for, since we were looking for short setups today, we saw a divergent range from here to here. Where is that level? Okay. So from here, starting from this level here, we had, when price came higher, we had this divergent range, and we set up for a short into these highs here. And we got stopped out over here. But because at the time, the setup was there, and we always take the setups. One of the nice things about our approach is once you have profits, the next trade simply risks the profit of the prior trade. We trade for, most people lose in trading because of three faults. And I've been saying this to people for 30 years. They have nebulous goals. They don't have any goal in their trade. You know, they get into a trade and they say, oh, it looks good, I'll see what I can get. They don't have a repeatable and measurable means of analysis and decision making. And they're looking at their wavy lines, and they cross over, and then they say, well, I think this looks good. Trade. And then they have poorly designed execution strategies, and or no execution strategy at all. They don't know how to get into a trade or how to get out of a trade. And then they have all of these complex scenarios about how they believe one thing happens because of this and another thing happens because of that. All of that stuff is not in our consideration. We trade in a complete news vacuum with the exception of Fed news and individual company earnings reports. But outside of that, we don't care about what's happening, and we don't even look, and frankly, we just don't care. We don't need to know anything that's happening overall in the market that will affect the perception of portfolio managers will show up in signal weight. These institutions spend billions of dollars collectively over the course of a year, and all of that, the result of all of that analysis is reflected in the trend in signal weight and also in the way in which we see the trades play out on our burst monitor every day. I'm sure you've all seen the tweets that I've had during the day, and we've only had one program targeting over 70 shares, and these levels down here on the bottom are very, very low. So the machines are off. I can bring up another day. Oh, wait a minute. I can't, not on this machine because I have it running on the other machine. But I could have brought up some history, and you'd see on an active day, this graph here, this green graph would be way up here at 25 or higher, and there'd be all this black space, which means that there were so many order entry systems on that they were quoting stocks at very high levels. In other words, lots of stocks were being quoted by multiple machines. Now, here's something else that people have to understand. All of these notions that people have about how evil algorithms are and that they're gaming retail and they're doing this and they're doing that to take advantage of this or take advantage of that, and that there's no liquidity out there. These are all false narrative, folks. I've been in this business for 42 years, and if you've just been into it over the last 10 years or since 2007, when Reg NMS went into place, when I was a portfolio manager and we needed to buy 50 or 100,000 shares of Microsoft or Intel, it would take hours and hours. And we would call the market makers. It would say IBM or something would be, 50 at 51 or 50 at a half. And they'd say, well, what price are you willing to pay? We'd have to give them an upper limit. I've sold, 5,000 to 7,000 shares of Google at a push of a button. I never could have done that as a portfolio manager. And the average price I would have gotten is nowhere near to the prices that we can get out right now. And all of this is so crazy. The market is so much easier to trade now than it ever has been before, because all of the basic trading strategies, and folks, there's really only a couple of them that institutions use, have all been now programmed. And instead of people pushing buttons, they have order entry systems pushing buttons, but they don't care about what retail is doing. Everybody's all concerned about spoofing. Well, it if it had an impact on you, the change in the price on something would be so fractional. If you're trading SPY, what difference does a penny make? And they quote SPY out now to 5 decimal points. Well, that means that a market making, an HFT market making system, if it had a 0.00001 profit on making a trade, which is matching a buyer and a seller, then they'll run that trade. And, it'll take them 100,000 trades to earn a penny. But, that's how their programs are set up. Go to Edgar and bring up the SEC Edgar database and bring up Virtue Financial, and go search back a couple of years and find their S1, their registration statement, and go read the business description of this company. And you'll see it says right in it, they don't trade inventories. 90% of retail out there thinks that market makers trade inventories. They don't, folks. When you can make 40,000 trades in a second, and as a market maker profit even a fraction of a penny, then that adds up into hundreds of millions of dollars every year. They don't need to trade inventories. They don't care about what you're buying or selling. And the algos trade the most obvious ranges, which is what these flip color bars and things that we use. Excuse me, folks, 1 second. So my opinion of all of these people worrying about HFTs are basically they're using them as a scapegoat to justify their own ignorance, in effect. So I think I've been trading for 42 years, and I can teach anyone how to trade intraday ranges and then apply that information to swing trades and longer term trades in 3 weeks' time. I can give you the basics in 1 week, in 4 days, which is what we do during our trading schools. And then we spend the rest 3 weeks watching these relationships play out in real time over and over and over again. And those SPY 75 trade setups are cycle originations on the primary delineator, which create what are called a trade type number 2s. And all of our trade targets are for 50 cents. This is another thing that I do. Our targets are very clearly defined, and our stop losses are equal to the amount of equal to our gain. So we have a 50-cent profit target, and we have a 50-cent stop loss. And by sticking to that methodology, we can make back a loss in one trade. And what most people do is they'll get into a trade, they'll take a loss, and then the next time they have a trade set up, since they just took a loss, they'll think to themselves, well, I'll be more conservative here and I'll have a smaller position. Well, they haven't been more conservative. They've been more risky. They've subjected themselves to greater risk, because instead of making a trade back in one trade, they have to now have more than one trade or 2 trades to make it back. And if you have 2 trades, that means you're exposing yourself to risk twice, not risk once. And so we stick to that. The trade type number 2s, number 1s, are intraday range trades. And we had one here. And if you go to hftalert.com/spy75.htm, I'll put that in here. If you go to that address, and there's the description of the 5 basic types at the top, and then there's a large table that scrolls down, and all of our trades that we've made this year and over the last 3 years are all in there, and they're all in real time. None of these are back tested. Back testing won't help you learn to do anything. You can't curve fit the past and expect it to work in the future. Plus, you don't have the opportunity to work with these flip color bars. So let's talk about those, since I see a question on that. So what a flip color bar is, back prior to Reg NMS, when I created the accumulators back in 1997, 1998, Jeff Donovan and I have been working together since, I guess, 1988, 1989, when we first met over a stock market bulletin board here in Santa Barbara. And he did all the coding, and very brilliant. Anyway, back then there were human market makers. And when you wanted to buy a share of stock, you didn't just push a button. You had to pick up the phone. You had to dial the number. You had to, hey, Charlie, how's it going? You got to say something or nothing. Goes, look, I want to buy blah, blah, blah. And then he'd quote you, and there'd be a 3/8 of a point spread most of the time on $10 to $20 stock, sometimes half a point spread, sometimes 5/8 of a point spread. And because why the word the spread so big? Is because there wasn't any liquidity. There's literally infinite liquidity today. For any of us listening to this and watching this, we can push a button and get our trades done instantly. And if the price slips a penny or two, so what? That's nothing compared to what we used to see. Anyone that thinks that you should be able to sell any amount of stock at any price at any time are crazy. They just simply don't understand how an auction works and how the market works. It's just nuts, and it'll never be like that. So what these flip color bars are, back in the day when there was human market makers, when a stock had news, and it would take sometimes 20 minutes to a half hour for news to percolate through everything. You'd have to see it on the PR or Business Wire news feeds, and few people saw that, and then they'd make phone calls and tell their friends about that. There wasn't all this instantaneous communication. And so when the NBBO got crossed, what would happen is say there were 15 market makers in a stock. Well, let's make it easier. Let's say there were 5. A lot of OTC stocks would have 5 or 6 market makers, and most of those stocks were IPO'd within the last year. So it was still basically the syndicate making the market, and 3 or 4 of the big wholesale houses like Sherwood, for example, where we did a lot of business. And of course, there were dozens and dozens, maybe hundreds of boutique shops all over the country. And, a stock would get active, and all of a sudden everybody's phones would start ringing, and the human market makers couldn't keep up with the other market makers that were making markets in that particular stock. They'd punch their level 3 machines and move their markets. And if you didn't keep an eye on them, suddenly, your offer would now be the low bid or something like that, or the high bid. So the flip color bars represent periods of time when the spreads were locked. And how that relates to today is when excuse me, taking a sip of water. When stocks get very active, when you see in the quote burst column here, for example, a stock is over like 2,000 quotes per second. What would happen when the spreads are locked and we see the flip colors now is that the NBBO rules, the routing rules, are suspended briefly. The same thing happens in the first and last 15 minutes of every day. The routing rules require that if you put in a market order and push and send that order in, whatever the high bid or the low offer, say you want to sell and put in a market, then your order will be routed to whatever exchange is currently at the high bid. And right now there's several, so it would be routed to that. But in the past, there might be only one bid at 50, one bid at 49 3/4, the rest of them at 49 1/2. So if you took out those first top bids, it would drop all the way to 1/2 with virtually no shares trading, because that's where the bids were at the time. So what happens when the routing rules are suspended is that the market makers are not held to the NBBO, the high bid or the low offer, at the split second that the order went in. So if there happened to be a bid price that was higher or lower, then that market maker could execute at those other prices which do not reflect the NBBO. So sometimes when the markets are very active, like in the morning, and you put in a market order and you look at it and go, well, God, that's off a couple of pennies. Or if you're trading a lower price stock, it might be off, a dime or 15 cents. Well, that's the way it goes. Those are the rules. They're not held to the NBBO. And that's the way it always was. The only amount that you got held to the NBBO was maybe 100 shares, and then they back down. So, the markets have always been like that. You can't assume you can sell any amount of stock at any time at any price. So that's within the liquidity accumulator, we can also look at the algos, and these are order entry. These are trades put in through automated systems, and then here are the dark pools. So if we take the full feed, which includes algos only plus dark pools plus everything else, then we can figure out where the volume's coming today. So we can see by the full feed that it's flat, right? There would be flat on the day. We can see that the algos are more closely aligned to that. They've, it's obviously up on the day. Here's the open, right? Okay, it's higher. The dark pools are lower. They've been sellers all day. So the fact that the line is positively sloped here tells us that whatever volume is coming in on dark pools compared to the volume on the algos and everything else is very, very light. Otherwise, this line would have a negative slope to it. And we only use the full feed. It's nice to see some color inside. I mean, we can definitely see that the dark pools basically sold from 293.16, all the way to the highs. And then it flattened. Now, flattening means that whatever buying was coming in was offset by selling. And since they were selling most of the time, what this tells me is that whatever shorts were made into here, they've now been covering those as it came down low. Exactly. Dark pools probably taking profits. Now, remember, that doesn't mean they think the markets are going to go up or down. Now we're getting some activity here on our burst monitor. So we've had a series of programs here. We had a big buy program targeting 329 issues. Here's some more buy programs. Must be some news. So we would now look at signal weight and would see that it had moved from about minus 100 to plus 100. Turn on our flip color bars, and we can see that the NBBO was crossed during that first one. We can see a little buy spike here on the accumulator. We can come to this big program here and see these are the stocks that are involved in that program. Apple SPY, Facebook. Looks like some gold as well. Here's another big buy program. There were 19, total of 20 programs, 17 buy programs, only 3 sells. You can see our signal weight is up about 200 ticks, which tells us that portfolio managers are doing a little buying. We can see that these were all portfolio. There's a sell program coming in. Now, if we were seeing selling across this move up, we would be looking to short that. These flip color bars will typically trade out half the range. So we would expect to see this back down into this level. See what happens, let's zoom in on this. What happens with these big programs that sweep through this is that they create order vacuums. And so there's no orders. They've all been taken out. Okay, so now half the range has been traded out. Look here at signal weight. It's really not moving much, plus 135. And we can see our cycle momentum is minus 5. Now, whatever news came out, we don't care what it is. Did we see most of our trades are reactive, not predictive. Trade type number 2s, which is when the delineator turns up or down, that triggers a trade, 80% of which make their targets. If you look through that SPY 75 page, you would see that on the trade type 2s. So we don't see anything to do here right now. And if we had seen selling across this move, we would have been looking to see where our ranges were, and we would set up a range to trade. Okay, now, so here's a little sell spike that's come in. We've had 23 programs, 18 were buy programs, 5 were sells. Let me turn off the flip colors here. We know that these are all, and the difference between the red and the green, the red, there's more buy volume, the green, there's more sell, or excuse me, the other way around. The green, more buy volume, the red, more sell volume. Interesting that the center bar here was not flip colored, so the NBBO was not crossed. Every other time where it was, any market order that came in would not be held, so to the NBBO, so market maker may have made a penny. Most high frequency trading, that trade like you and I would trade, a position, they trade for 3 to 5 cents. So if you could make 100 trades for 3 cents a day, you would harvest $3 out of SPY, and your trade would last less than 1 second, because all you'd need would be 3 cents, 3 to 5 cents. If you bring up a 1 second tick bar, just look at the difference between the high and the low per second. You'll see it's 3 to 5 cents. And even though when you're looking at these, you don't see that kind of a change, it's just too fast. There's not the tick resolution. But a 1 second of time for a computer is a long time. Let's look at some of these trade rates on this big buy program here. All right, so SPY in that second, the NBBO changed 863 times, and there were 396 trades in that single second. And well, of course they're ready to do a deal. I've seen 42,000 SPY trades in 1 second, and there was a $1.50 spread between the high and the low during that 1 second period of time. And even though if you were standing and looking at your computer, you wouldn't have even seen a change. It would have taken you 3 or 4 seconds to realize what had just happened. So here we see some selling. How do you handle large orders that are spliced? By spliced, I assume you mean cut into small pieces? Answer me yes or no. Oh, wait a minute. I can hear someone's talking. Hold on a second. I'm sorry. I could hear that someone was talking, but it's just not loud enough on my side for me to make out what you're saying. Is there a question relating to that? So a failure to deliver is the responsibility of the brokerage firm. And it wouldn't matter who was running a trade. You or I could fail to deliver, and, that would be our problem. They'd sell us out and take the money out of our accounts. Spoofing, it's just, I understand. Anything that I have seen that I would consider to be some kind of a manipulation has resulted in a change of a penny or two on a stock, and it just really wouldn't have, it just doesn't make a difference. If you compare the amount of time it takes an individual to get their order into the system today as opposed to in the past, prior to Reg NMS. It's just whatever price loss you think someone's getting from spoofing or any other manipulative practice compared to the slippage involved in the amount of time it would have taken you to just get to an order. There's just no comparison. People don't realize how good they have it today, especially as a retail trader. So, oh, I'm sure, we can talk to you about Reed Slatkin if you want to talk about. Okay, so let's look here at the accumulator. Let's get back to our software. So we can see that this has been selling starting at 136. So they're selling into these moves. Let's see where it's coming from. You can see that the algos are taking profits and the dark pools are predominantly the selling. We do all of our trading with all of this going on, and our results are not skewed. So it doesn't matter to me whether there's manipulation or not. The results that you see for our users that are using our software and our approach, we've never had a down year. The results are all right there. It's all in black and white, and our users can attest to that. So I frankly don't see a problem with any of this. And people that, think spoofing and everything is manipulated, I don't. I think the markets are so much easier to trade today than ever before. It's just astonishing. So we can see that they've been selling primarily the dark pools over the course of this. We look at our delineator, which went into an upcycle on the 3rd. There's nothing for us to do there. We don't have a slope change coming anytime soon. All of our software is predictive. Here's something we call our stats calculator, which shows us at any point in time, even though I teach people how to calculate this manually, is we know what level of signal weight we would need to see for a down cycle to start. And signal weight would need to, whoops, that's the secondary, hold on, to drop to minus 1520 for this to drop. And for that to occur, we would need a major exogenous event to reverse signal weight. Now at the open today, signal weight was at that level. We were at minus 1400 at 10 o'clock. So we had a signal weight reversal. And only portfolio managers can move signal weight. And so when you study the trend in signal weight, what you're really doing is studying the trend of portfolio managers. And it's the long-only generational institutional portfolios, all the public mutual fund money, the endowments, the pension and profit sharing plans. These are portfolios that never exit the market. If they're selling something, it's for only one of two reasons. One is to meet a redemption, and the second is that they need to lower their allocation to that issue. And if they're lowering the allocation to one issue, they're raising the allocation to another. So as price goes up on a stock like Apple, for example, and let's bring up a 15-minute Apple accumulator. And let's increase this to 2,500 periods. Okay, the market pressure accumulator is the accumulator that has that is predictive. But if we look at the liquidity, we can see that it's just going down, 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 down. Both algos and especially dark pools, a straight line. Well, that's because as the price of Apple goes higher, the percentage weighting in its portfolio also increases. And big institutional portfolios are run by very complex metrics. And they want to be sure that the dispersion of return isn't concentrated in a few issues, because that is an institutional measure that big institutions pay a lot of attention to. They want to see that the portfolio manager is responsible for the gain, and that gain is spread across its entire portfolio and not concentrated in a few stocks. If it's concentrated in a few stocks, a typical institution will consider that a stock jockey is running that portfolio, and they won't want any part of it. So seeing the accumulator continuously decline is, I think, indication of exactly that process going on. Now, the buy-sell accumulator also looks for a different kind of a transaction. The liquidity looks for one kind, the buy-sell looks for another. And here we can see here as well, they've been selling here into this last high. And again, not so much because they think the earnings are going to be bad and the stock will plummet. You know, that's what you'll hear on TV. Now they're lightening their positions. So you really got to understand what these tools are really designed to do. And it's the easiest for me to teach people if we trade intraday ranges and understand that we are predicting which direction we're going to be seeking setups. And right now with cycle momentum only 1.5, we're not going to seek any setups. Plus or minus that number there, that cycle momentum number has to be greater than plus or minus 20. And for us to consider trading. So is a short developing? No, there's nothing developing right now because cycle momentum is flat, and we don't care what else is happening because our short-term range trades aren't set up because of whether we think the price is going to go up or the price is going to go down. They're set up because of what direction the slope is moving and which direction will be easier for price to move. And so we would, the accumulator, the delineator is still in an up cycle. We're in the terminating phase. We know that the next cycle will be a down cycle. The secondary, which is on the daily time frame, has been we had a short into the highs here back in late September, and we've already earned, I think people took 6.5 point gain, then we had a 10-point gain in this at the lows after 3 days. But that's called a trade type number 4, and that's a multiple day swing trade. The trade type number 2s are cycle origination trades, and the trade type number 1s are range trades. So if we had say from this level here down to this level here, if this had risen while that had fallen, then we would have had a divergent long setup, but because cycle momentum wasn't high enough, we would not have taken it. If you look through that SPY 75 results column and look for the number of trades that were either stopped out at cost or stopped out for a loss, and compare those numbers to the ones that achieved their targets, you'll see it's skewed very much in favor of the gains versus the losers. I know that to learn to use my software, you can keep doing whatever you're doing, but if you're going to use our software, you really need to learn how it is we're using it and learn what that is, which will give you a totally different viewpoint of trading and will take away all of this, all of this price following stuff. If you look at the pinned tweet at HFTalert.com, that was a graphic invented by Ian Notley, who's the smartest market technician who ever lived, even greater than Gann. And Ian, he's passed away some years ago. But I learned a great deal from him. And some of what I learned is also in here. But if you're going to use our software, you really need to learn these trades. So our SPY 75 program is set up as a learning tool. And what it does is it forces you to earn and expose yourself to risk while you're learning these things, because you won't, these are predictive tools, and to buy into the lows and to sell into the highs doesn't necessarily mean you're a contrarian. That's the way you're supposed to do it, right? We're supposed to buy low and sell high. So that's what our software forces you to do. We don't care about ranges that we didn't trade, because any range that we don't trade today is a range that we'll be able to look at tomorrow. So we didn't care about this rise. It just really didn't mean anything to us. This rise you couldn't have predicted because it was triggered by an exogenous event. Yet people will look at their charts and they'll say, oh, well, it bounced up there because it hit this moving average. No, it didn't. So the software is pretty unique. Here's our VXX chart, by the way. Note that there's no price on it. We don't see any price at all. We're just looking at whether the algos are buying or selling VXX. So if they've been selling VXX through to about 1223. So we know that if a program is going to sell VXX, then they're expecting price to go up, SPY to go up, because the price of VXX obviously is inversely correlated. So you can see here at 1225, they basically stopped, and they haven't sold any more from that level. Remember, this is an accumulator. So there's no more buying or selling has occurred during that time period. And many times we'll see this thing spike up, the market doing absolutely nothing. All of a sudden it spikes way up or it spikes way down. And a few minutes later, sometimes we'll see a program hit. We've got 18 programs, 25 programs, 18 buy programs, and 7 sells. So you can see that basically by 134, these programs finished. Let's look if we've got any more flip colors there. There we go. So I'll pause. I've been talking a long time. Anyone got any additional questions? And I would expect this entire range to trade out. So go to HFTalert.com. Let me bring this in here. I can show you a few things. So if you come here and come to our trading school sign up, there'll be a section here. I encourage you to look at this lesson plan, which is this right here, and it'll tell you everything that you'll learn. And the main thing about our software is that you have to see it in real time to understand how it works. You need to see a dozen or so cycle originations. Can you touch on a comment you made earlier about half the range trading out? Okay, so the range being of these flip color bars, these were caused by these programs down here. And notice none of them were cappers. So typically expansion bars, let me turn off the accumulator here. Expansion bars like these are caused by programs that sweep through a range of prices, leaving order vacuums in their wake. Typically, you'll get a reversal. These come in 2s and 3s. The third is typically a reversal bar where it makes a higher high and closes at the low. Sometimes it's the 4th. But typically, half that range will trade out. Now, if we had a divergent range, if they had sold this entire move up, and we see that often, and we'll get $1 or $1.25 divergent range, and we'll trade that to the midpoint. Sometimes we can trade it all the way to the base. If this number over here was -30, for example, we had negative signal weight rather than positive signal weight, even just with this selling alone, we would have the expectation that this entire thing would trade out. And for more aggressive users, what they do is they'd short these highs, because we want to, when we see an expansion bar up, we want to get as high to that, enter into the high of that level as possible. And then as soon as it's moved a reasonable distance down, assuming we maintain strongly negative signal weight and strongly negative cycle momentum, they'd move their stops to cost fairly quickly, and then focus on their target and exit at their target. What we don't do is try to milk a trade. There's two hammer conundrums that I've learned over 42 years. Hammer conundrum number one is when I trade for more, I end up with less. And hammer conundrum number two is when I seek to avoid a loss, I end up avoiding a gain instead. And that's how we have our SPY 75 things set up. And so that everything is skewed to making it easy for you to make money while learning how these things work, and be in a position where the losses that you do take are going to be minimal and can be earned back in a single trade. And part of learning that discipline is creating the confidence that you'll need to step out in front of price, because that's what you need to do to be successful. 100% of our trading that I do in the journal, what we also have is, let me bring this up as well. Hold on one second. Everything that we do for SPY is directly related, can be directly translated into trading ES. So here is the delineator journal, has multiple sections. Here's our secondary section. But during the day, I make these posts and we'll set up. So here's our setup here. Here we're tradable low at 293. So we need a rise to 293.58 with continued selling. Price 293.64. So we had a range in place, continued selling, and a range is now in place. The higher price can go, the larger the range will become. Trade type number one, the short is on at 293.75. Put in our target, 293.25. See, I have those reversed. The target's 294.25. The stop is 293.25. And here we got stopped out at 11:01. So what I do during the day is I will put on, while we're in our chat rooms and on the journal, I will post the trades in real time as they're set up. And so that's really valuable for people. It's like me standing in back of them as a trading coach, which I am. But our ultimate goal is to make everyone self-reliant using the software, the delineator, the accumulators, the burst monitors, to know when programs are run. And we have a set of rules that we teach, and hopefully that will translate into profitability and long-term gains for you in the market. So thank you very much. I'll stand by for a few questions. Otherwise, we will hope to see you in the Delineator Journal or our chat rooms. Our typical trades last anywhere from a few minutes to an hour. Why do I trade SPY instead of ES? Because not everybody has access to ES. And if you compare ES with SPY, they're one-to-one relationships. Many of our users will trade SPXL or SPXS, which have a 3x correlation and inverse correlated. Many of our people use options. They day trade options that are expiring very soon so that they get a big move. I run a class every couple of months. We have one starting October 15th. We limit everything to 30 people. We've got, I think, 15 or 16 signed up right now. So if you go to hftalert.com and look on the trading school, there's all the links up there for you. 90% of our trades happen within the first 2 hours. 90%. And, if it takes more than 2.5 hours to wait for a trade, you're better off playing golf or going bowling. by then our cycle momentum's always the highest in the mornings at the open. So 99% of our aggressive traders are there at the open. And we ignore anything that happens pre or post market, as should you. The best thing about the market is it closes. Okie doke. Thank you so much, everybody. And Danny, thank you. And Marlon, thank you so much for all your help.